Edge. Bob? Hello, Scott. Oil ETFs are tanking on renewed trade war worries. The S&P Oil and Gas Exploration ETF, XOP, that's a more than 3-year low earlier today on fears of continued tariff escalation between the U.S. and China. Let's break all this action down. Dave Nadig's here of ETF.com, Kevin O'Leary of O'Shares ETFs. And Dave, I love oil because it's a classic supply and demand story. The markets seem to be telling us right now that there is a massive oversupply situation. Well, and is that going to change?
I think that's absolutely true, right? We are in a global oil glut, and we've got OPEC trying to do something about it, but all on the backs of Saudi Arabia. That's not going to last forever. You know, I think there's really nothing I can look at other than maybe a calamity in the Persian Gulf that would drive prices up. Everything is pointing towards oversupply. And on the demand side, we're seeing signs of a global recession possibly in the works. None of that's ever good for energy prices.
Kevin, we've struggled for alternative ways to play energy. It's 3 or 4% of the S&P 500 at this point, but might there be another way to play it? You have talked to me in the past about using currencies as a play, and there is a relationship there. Explain that to us.
There is. Here's what I like to do. If I want to go long oil, I'm starting to get interested because it's been crushed so much. Time to buy oil is when everybody hates it, and they're hating it a lot right now. But you don't have to buy the oil itself. You can buy the currencies and indices of countries that are basically tied and pegged to oil prices. I'll give you an example. Australia moves very closely to the price of oil, but the one that's even closer is Canada. You can basically transfer some dollars into Canadian dollars, buy an index like the XIU, which is a 60 stock index of Canada, which is basically energy and banking. But here's the sweetener. If oil moves, you get a lift in the currency and you get a lift in the index, which is how I'm playing it. Plus, you get an added bonus on the Canadian story. The government looks like it's going to lose in October. It's a socialist government getting kicked out for a more right-wing pro-business. That could also help the currency.
Dave, there is a little bit of a head fake going on in energy this year, because if you look at the XLE, it's up 3%. And you say, oh, hey, well, it's not that bad. But in fact, the XLE, which is the big oil ETF, is only being held up because a few of the big caps, your Chevron and Exxon, are essentially up. 45%. And everything else is just awful here. Why are we getting a couple big cap names up and everything else is
Chevron and Exxon are the two big, truly integrated performers here with decent balance sheets. They, in their recent reports, they had good upstream earnings, bad downstream earnings. They can weather some of this storm. So they're sort of stalwart, high-yielding blue chips. The rest of the sector can't keep it together.
Well, Joe is mentioning small cap energy and the debt issues. You look at Range Resources, Concho's down 30%, for example, and the services names, Diamond Offshore is down 25, 30%, Transocean, Noble, all of them down as well. I think Joe brings up a very good point here.
Those are their acquisition targets, frankly. You expect companies like Exxon and Chevron to survive downturns like this, have solid balance sheets, and start picking those companies up.
You know, one of the things I noticed, Kevin, is essentially a lot of energy hedge funds are going out of business. They're simply gone. I can't call the same people I used to 5 years ago. They're not there anymore. They're not even answering the phones because the companies are basically down at this point. Is there any future? Is it always going to be 3 or 4%? Remember in the 70s? When it was one of the largest 2 or 3 sectors, energy was back in the 1970s?
I think there's another shoe to drop because you guys touched on it. If you think about the bottom of JNK, one of the most popular credit ETFs in the world, that 18% are single C's, the majority of which are energy. Now, oil stays down here. Those guys it's covenant-like debt. That's going to be a bad outcome for that bottom 18, those single C's, double C's. Those are nasty pieces of paper. I'd say another 6 months of these prices, and you're going to see a big correction on the bottom end of anything that has to do with a lot of single C credits. And it's going to be a bad outcome.
Well, we heard about the debt issues going back the end of last year.
Every time we have a problem in energy, people point to the junk bond market and they say, this is where the problems are going to be.
And we're watching the high yield sector because that's where this tends to show up. Dave and Kevin, thanks very much for joining us.